Hey everyone, Rob Foglia with Foglia Properties at Keller Williams Realty in Nashville, and we're coming to you live today to talk about an exciting topic, and that is mortgage interest rates. We're going to dive into what they look like today, what it means for home buyers, what it means for current homeowners, and then lastly, what it means for real estate investors. So if you're in one of those three buckets, a home buyer, a homeowner, or a real estate investor, let's stay tuned and let's take a look at everything. First off, though, let's start. I'm going to share my screen and let's dive right in. And let's look at what rates are right now. So this is straight from the Freddie Mac website, the primary mortgage market survey that Freddie Mac puts out every single week. And you can see rates officially climbed over 7% for the first time. In fact, last week they were 6.94. I mean, it's basically 7, but you can see they're still climbing up. And just to put this in historical perspective for you, it's a 10-year high. I mean, we've got to go all the way back to, where was the 7? I saw a 7 right here in 2002, it looked like. Yeah, right here in April of 2002. So over 20 years since they've been this high. So rates have definitely jumped up. A lot of people are thinking that this is, basically this is a reaction to help curb inflation. We'll see what ends up happening. We don't know how long they're going to stay up like this. So for everybody that's out there that's hearing, well, buy now, move now, and refinance later, guys, you don't know when this is gonna be back to here, if it ever comes back to here, or if we ever see it in the 2s or the 3s again. I'd love it if we would, just as a homeowner, as a realtor, as an investor as well, but we don't know that. So just keep that in mind, that the only market you can work with is the market we're in today. No one knows the future, so don't buy or make a move on speculation. Make your move on what works for you today. So knowing that rates are about 7%, let's start with home buyers. How does this affect the market? Because I know a lot of people would think, well, gosh, rates have doubled this year, more than doubled this year. So that's got to make the market soften, which would be good for home buyers, right? Well, not necessarily yet. And so what I've got pulled up here, these are stats from our entire MLS that RealTrax puts out there. And this right here is, we'll jump to this in a second. This is the median sales price for our market. And you can see, just to jump back to rates, rates have been climbing all year. In fact, September 1st, they were 5.5%. You can see they've jumped over, almost 1.5% in about 2 months. And you can see September 1st, they were 5.5%. The market was, rates were still climbing. Prices were rising still too in September. So August to September, they still went up year over year. They're still up over 13% from September of 2022 compared to September of 2021. So we haven't seen the market negatively react to interest rates yet. We have seen it slow a little bit. You can see this massive rise from January of 22. The entire MLS's median sales price was 350 to May of 2022, going up to 407. Like, that's a huge increase, more than we would typically see in a given year, especially a pre-COVID normal market year. Keep that in mind, and also keep in mind, home buyers, that real estate is supply and demand driven. So because of rates, because of homeowners that have an attractive rate and don't need to move, so think about it for a second. If you're a homeowner and you don't necessarily need to move, you just kind of you might kind of want to get into another neighborhood, or maybe you would like more space, but you don't have to. We're gonna talk about that in just a moment. But a lot of those homeowners are kind of staying tight, right? Staying put right now, and I get that they're hanging tight, and there's a reason for it, and so because of that, inventory is still down. Like, the amount of homes for sale in September of 2022 in the entire MLS, all of Middle Tennessee, so which is dozens of counties, is just a little bit more than 15,000. Just to put that in historical perspective, let's just look back at 5 years. I mean, you can see where the market was pre-COVID. September of 2019, 21,000. So you can see that's a pretty big decrease. That's only 75%, roughly, a little less than 75%, probably closer to 2/3 of the amount of homes that were for sale pre-COVID. So we haven't seen this rise. In fact, let's get off the entire MLS, because our MLS has changed recently. They've even added counties, which kind of throws things off. Let's just look at, say, Davidson County, Nashville's county. 3,300 homes for sale in September, down 21%. Compare that to pre-COVID numbers. September of, if I get the mouse to work right, September of 2019, 4,700. So you can see it's down, again, roughly 2/3 the amount of homes that were for sale in September of 19. Even if you look at September of 20, gosh, 5,100 compared to 3,300 right now. Until this rises, until we see either inventory levels rise, to basically outpace demand, we're still going to see what's considered a seller's market. Months of supply is what we measure this on, and you can see it's climbed a little bit. Again, we still have Davidson County pulled up, 2.6% compared to the all-time low of earlier this year. But guys, 2.6 months of supply, that is still a strong seller's market. In fact, to go back to the last time we saw a buyer's market, which was basically in 2012, that's right here. That's 6-7+ months of supply. So 2.6 months, guys, this is still a seller's market. Again, I don't have a crystal ball. I don't know what this will look like next year. I'm just doing this to inform the home buyers out there that the market hasn't turned yet. So if you're waiting for the market to turn, who knows when that'll be? I for one, would have thought with rates doubling this year that we'd really start to see that happen, and we haven't yet. So again, just throwing that out there. Now, what does all of this mean for homeowners? And I want to put you in a hypothetical. Let's just say you bought your home, I don't know, 4 years ago, 5 years ago, bought a nice home in 2018, $450,000, financed $400,000, maybe still owe $400,000 on the home. Just pulling out a hypothetical and showing you what this could look like. So say you still own $400,000 on your mortgage, and your rate's 3%. And they maybe refinanced at one point, your rate's 3% right now, and you've got, I just filled in, round numbers, $1,000 a year for insurance, $2,400 a year for taxes, no PMI, especially if you refinanced. Your payments less than $2,000 a month. I'm just walking through a hypothetical because let's just say like this right here, 4 or 5 years ago, they bought, maybe they refinanced, they still owe a decent amount on their home compared to what they originally paid. But say if they bought it 4 or 5 years ago, that home for $450,000, that home's probably worth $700,000, $750,000 right now because of what values have done recently. Well, if that's the case, and this is your hypothetical, you've got to think about what you should do in terms of the market. And honestly, if I were you, I would really only consider moving if you had to move, if it was a must move, or if you could afford a number like this, instead of that $2,000 a month payment, if you could afford it to go up to, increase by more than 50%. And so like what this is right here, this is a mortgage calculator that we've got on our website, and feel free to go to foliaproperties.com. Just click this top Foglia Properties, scroll down to mortgage calculator, and you can pull it out. But this right here, and I'll show you what I've got. So let's just say you were looking for something a little bit bigger, a little bit nicer, maybe more land. I don't know. The whole reason that people make those ancillary moves, the moves that they don't have to make, but they want to make. So let's just say you were looking at a home that was $750,000, because again, appreciation, maybe you're moving up a little bit, you want that more space. And let's just say you were that hypothetical from this. You owe $400,000. Let's just take closing costs, moving costs, all that out. Let's say you're going to have a $300,000 down payment if you sold your current home for say $750,000 and bought one for $750,000. Well, you've got 40% down then at that point. That's fantastic. You're only taking out a loan for $450,000. That's barely increasing your principal amount over the $400,000 here. And yet, what I want to share with you is at a 7% rate, 30-year fixed, same taxes, same insurance that we just looked at, no PMI. Your payment is almost $3,300 a month. It's a pretty big increase. Now, I've heard some people talk about, I've heard some lenders, I've heard some real estate agents throw out the term 2-1 buy down to say, hey, buy now, do a 2-1 buy down, get a low rate, knock your payment low for the first year or two. And I'm going to explain what a 2-1 buy down is in just a second. And then, that'll be a couple of years from now. You can refinance and all that. Guys, we don't know what rates will look like in a couple of years. In fact, as rates were jumping up earlier this year, let me zoom in a little bit. We'll look at the 3-year. As rates were jumping up, probably around here, I would say in June, July, I was seeing a lot of agents say, we'll marry the house and date the rate, meaning buy your home and date your rate, refinance later. Let's just say you bought your home right here. You were 5.5%, somewhere in there for a mortgage, and you thought, well, hey, I'll refinance when it jumps down to 3. I can afford this payment for a little while. If you were waiting to refinance, I know it's only been a couple of months, but guys, it's 7% right now. We don't know what rates are going to do long term. So a 2-1 buy down to me could be a little bit risky. I've got the definition for a 2-1 buy down pulled up here from Investopedia, and I say risky, by the way, only risky if you're struggling, if you can kind of only squeak by with what that final payment will look like, because a 2-1 buy down is a type of financing that lowers your interest rate on a mortgage for the first 2 years before it rises to the regular permanent rate. The rate is typically 2 percentage points lower during the first year, 1 percentage point lower in the second. Some may offer a 2-1 buy down right now to make a property more attractive. And yet again, as a homeowner, you've really got to consider what that might look like, because let me just show you what that means. Say nothing else changed right here, and you had a $750,000 purchase, 300 down, and instead of 7%, you've got a 5% rate, 2-1 buy down. Well, you can see 2,700. That's a lot more attractive than 3,300. In fact, if you're thinking, hey, my payment right now is $2,000, I could squeeze out another 700. Maybe you just paid off your car and you can squeeze, you can afford that. And you're thinking, I'll refinance later when rates are back down to 3, and then my payment's just barely more than it is right now. Again, guys, we don't know if rates are going to ever get down like that again. So you've got to act like, what if you had this loan, that 2-1 buy down never was able to be refinanced, and you had that 7% rate for years 3 through 30 of the life of the mortgage. Well, if that's the case, this would be your payment for years 3 through 30. So just think about that long term. I just want to encourage everybody to not get in over their head, especially for those that are making more again, just like optional moves. The people who are out there that are saying, well, I just kind of want something a little bigger, the want to moves instead of the need to moves. Because I know there will be those that are out there that are getting transferred for a job. They need to move across the country. If that's the case, you might have that 7% rate, and you just got to do your best in that instance. Maybe you're a family that's growing and you're out of space and you have another kid on the way. And if that's the case, you might need to make that purchase. And if that's the case, just do the best that you can with the numbers that we're seeing with these high rates. And yet, if you're just kind of thinking about maybe moving, just make sure you're playing it out as in, this is what my payment will look like, worst case scenario. Don't look at it and say, well, hey, I might be able to get that better rate in a couple of years. Let's take that chance, because that's when people might get into trouble. And now the last thing I mentioned at the beginning of our video here, that we were going to talk about home buyers, current homeowners that might want to move, and then investors. The last thing I want to share with y'all for an investor that's out there is does it make sense to buy with these current rates? Guys, don't overthink things as investors that are out there. Just remember that when it comes down to it, an investment property has got to be unemotional. It's got to be numbers driven. So just like if rates were 4%, 3%, 7%, 20%, it doesn't matter. Does it cash flow? So let's just say you were looking at a property, and we're just going to throw in some numbers here. Like, let's just say this was a year ago. You were looking at a $250,000 investment property. You were putting 25% down. Maybe you were getting a 4% rate a year ago as an investor. Let's keep everything else the same. Your payment would have looked a little less than $1,200. And let's just say a $250,000 property, you were able to get $1,700 a month in rent right there. That's a win. You're making $500 plus a month. You can have a property manager. You're going to be in a good spot. Now let's pretend that you were buying this exact same property today, still $1,700 a month in rent. Let's just say your rate wasn't 4%. Typically, investment rates are about 1% above prime. So if right now, or par, excuse me. So if you're looking at a 7% rate for a typical owner occupant, well, you're actually going to be looking at about an 8% rate. Let's just say for an investor. So 250, 8% rate, 25% down. You're right at 1,700 almost, 1,650 a month. You've got to ask yourself, does this make sense? Does that $41, if you think you're going to get 1,700 a month, make sense for me to buy this investment and go from there? To me, it'd be borderline. The only reason I say borderline is it is cash flow positive and rent rates have been rising. And yet at the same time, you have no buffer in there either. You don't have necessarily the, that you're reserved for vacancy and repair. So as soon as one thing happens, whether it's the HVAC goes out, you have a tenant that stops paying, maybe you can't fill that vacancy for 30 days, all of a sudden you could be looking at an investment that's cash flow negative for the year. So just know that this to me would be risky at just these exact numbers, and again, that hypothetical $1,700 a month in rent. Obviously, there's a lot of play in terms of the numbers with investments. You could look at, what if you put a slightly higher down payment down? What does that look like? If your rate was a little bit lower, if you were able to refinance in a little bit, if rental rates have increased a little bit too. There's a lot of things you can do to forecast long term for investments. Just know that with investments with rates this high, you've got to pay attention to that cash flow. And it really does come down to cash flow. I mean, again, if rates were, say, instead of 8%, I know I was talking to an investor client of mine within the last couple of months before rates had jumped up quite this high, and he was looking at a rate in the high sixes. Let's just call it 6.5 for right now. Nothing else changes. His payment was 1468 right here. So it's becoming a little more attractive. So again, just look at your numbers if you're an investor before you decide to pull the trigger on an investment property. There are some great opportunities that are still out there, because if this property 250 was getting more than 1,700 a month, let's just say, again, pretend it's 8% for your rate, and let's just say you're getting $2,200 a month instead of 17, which, I mean, there might still be some investments that are out there that might make sense along these lines. Now all of a sudden, 1,659 for your mortgage, you're getting 2,200. It starts to make sense. So just know there are options. You've just got to be very strict with your numbers in this type of market. Guys, I feel like I've talked forever here. It's probably only been about 10 minutes, but I've probably a little bit more than that. And yet I appreciate y'all tuning in. Again, if you're a home buyer, a homeowner, an investor, I trust this has been worth your time. And if there's anything you need, reach out to us. We're here to be of service. We're here to help in any way that we can. If you're seeing this live on Facebook, drop a comment, hit that like button to help us out. If you're seeing this on YouTube, please do the same thing. If you have a question, just leave it in the comments. We're happy to get back with you. And of course, if you're getting this in your email and you have a question, just hit that reply button and we'll help you in any way that we can. As always, y'all, I appreciate y'all checking this out. Hope y'all have an amazing day, and we'll talk to you soon. Thanks, y'all.